Part 2. Income, Interest Rates, Policy, and the Open Economy. Chapter 3. Spending, Income, and Interest Rates. Simplification. Economic theory is a process of simplification. Simplification allows us to study parts of a problem, one at a time, and then bring together those parts into a more complete model of the economy. The parts you will see in class from this chapter are as follows: the IS curve and the consumption function. The consumption function and saving. The consumption function. C is equal to CA plus C, open parentheses, Y minus T, close parentheses. C stands for consumption. CA is autonomous consumption. Lowercase c is the marginal propensity to consume. Y stands for income, and T stands for taxes. The consumption function. A numerical example. We know that C is equal to CA plus C, Y minus T. Our autonomous consumption is made up of 900, 200, 600, 100, and 200. Adding these three up, 6 plus 2 is 8 plus 1 is 9, and 9 plus 2 is 11. 11 and 9, that's 20. This then equals, our autonomous consumption is 2,000 plus a 0.75 marginal propensity to consume, a 4,400 income minus 400 in taxes. This equals 2,000 plus 0.75 times 4,000. This equals to 2,000 plus, when multiplied out, is 3,000. This equals 5,000. Our consumption equals 5,000. The consumption function for a college student. Again, we know that the consumption is C is equal to CA plus C, Y minus T. We have 1,000, 850, 1,400, 100, and 200. 8 and 2 is 10. 10 and 4 is 14, and 1 is 15. Carry the 1. We have 3,550 as our autonomous consumption, plus 0.75. Our college student has an income of 0 and taxes of 0. This equals to 3,550. And this is our consumption. The college student's example is considered dissaving because debt is used to finance autonomous consumption. Autonomous consumption is the minimum level of consumption or spending that must take place even if a consumer has no disposable income, such as spending for basic necessities. Induced saving and the marginal propensity to save. Savings is equal to income minus taxes minus consumption. The equation right below it has the consumption function substituted for C. S stands for saving, Y is income, T is taxes, and C is consumption. Saving. We know that S is equal to Y minus T minus C. Our Y is 4,400, our T is 400, and our C is 5,000. This is then equal to 4,000 minus 5,000. 4,000 minus 5,000 is equal to negative 1,000. Savings is equal to negative 1,000. Marginal propensity to save. MPS is equal to 1 minus MPC. S stands for the marginal propensity to save. C stands for the marginal propensity to consume. NPS, a numerical example. We know that the marginal propensity to save is going to be equal to 1 minus the marginal propensity to consume. We're trying to figure out S, which is equal to 1 minus 0.75 is 0.25. S is equal to 0.25. The IS curve. Our IS curve is going to be a graph that shows us the relationship between income and interest rates. When interest rates are low, this means that GDP is increasing. The reason is as follows. If a credit card company offered you 0% interest rate, you'd be able to make a couple purchases that you've been putting off. And likely, businesses could take out loans to make investment with 0% interest rate. However, when interest rates are very high, say that they're offering you a credit card for 20%, you're not as inclined to go out and purchase what you would like to. So GDP decreases. Similarly, businesses aren't as likely to go out and get loans to make investments in their company. The S-curve then looks as follows. We'll analyze 3 other points and show when interest rates move here to a lower interest rate of 15%, GDP corresponds at 4,000. But as interest rates lower, GDP continues to increase. This is because people are more willing to go get out to take out loans, and so are businesses. Our next point is 8,000.